There we go. We'll spend about a second on that, and that's too much. Okay, let's go. So the quote to lead off this one, it comes from the king of bonds, Jeff Gundlach, who has been over the years truly one of the best bond market investors on the planet. And he thinks treasury bonds are attractive, but not for the long term, because the deficit's going to be so bad that in the next recession, we'll have to have radical policy changes. And basically what he's talking about is a very inflationary response to the next recession. I think he's dead on. I think it's an extremely important point. We'll talk about that more coming up. Okay. This is a pretty funny one. It almost seems like it's ludicrous, but when you think about how popular these buy now, pay later programs are becoming, it's really not that much of a joke. In fact, Mark, who's on with us now, one of my creative wingmen, was saying he saw a buy now, pay later offering to purchase a $24 item over a 7-month time frame. It is funny in some ways, but I think it's also reflective of the kind of stress that consumers are under currently. And that's why you're seeing credit card debt go up so much. It's now over $1 trillion with 20% interest rates, and credit card delinquencies skyrocketing, as are auto loan delinquencies. So there's maybe this falls under the category of dark humor. Thank you. So it's kind of another little funny, but for those of us that are old enough to remember this ketchup commercial from 1978 and the great song that goes with it. I remember those days. Can we hear it? Not hearing it at my end. Anyway, that's Carly Simon singing Anticipation. Okay. So it is a little embarrassing for me to admit that my 2022 expectations were better than those in 2023, but it's just the facts. And I do use the term anticipation or expectations instead of forecast or predictions, because I want to convey that, I'm not some kind of genius or savant or, somebody that's got the ability to predict the future. It's meant to express my admitted fallibility and express some humility. And do any of you remember what Yogi Berra said about predicting? Oh, you already listened. It's not fair to Adam and Mark, but his famous line was, it's always hard to make predictions, especially about the future. And it's another one of his brilliant lines. And so true. Okay. So this is what I talked about at the beginning of last year. It's pretty important stuff. We're going to go over what I said. We'll also talk about some of the evolving aspects. So it's not just backward looking, although most of the forward looking stuff is going to be in the next webinar that we do. Probably the most important things on here are the economy, and particularly this recession, no recession, soft landing, hard landing thing, the U.S. government funding crisis, credit spreads, and of course the Fed. The Fed's always super important to the economy and financial markets. All right. So inflation, actually one of my better calls, because I thought it was decelerating and would continue to decelerate into 2023. A lot of people argued with me and said, oh, you don't get it. Inflation is really sticky. It's going to stay at these high levels. But there was just so much commodity deflation already occurring at that point. It just seemed inevitable. And also that you would get eventually falling housing costs, either purchase prices coming down for homes, which is a topic we'll talk about. It's been very mixed in that regard, but cooling rents, which is definitely happening. I just saw something that rents in some cases are actually running negative. But regardless, I thought that most of inflation would start easing, but I did warn that I thought wages would be sticky. They have indeed been. We're actually seeing wage increases at a rate that's basically the highest since the 1980s. And we're, very obvious. A lot of these huge wage settlement contracts that, like the UAW, where wages are increasing 8 to 10% a year. I think I mentioned in one of the previous webinars that the average UPS driver is now making $170,000 a year. And that's obviously a huge number. And that's what happens is that then the auto workers see that they want to get paid more, and even non-union people start militating for higher wages. So once this wage train starts really going at a faster and faster clip, it does tend to embed inflation. But nonetheless, in late October, there was a somewhat soft CPI reading. It wasn't that soft. It was like 0.1%, 10 basis points below expectations. But it was enough to set off this big rally in stocks and bonds. And, it's the time of the year for rallies. October's often the low, and sometimes it's a catastrophic low. This one was really fairly mild, and that's what's always tricky to know how low is low. But anyway, the question that everybody wants to know is, will it continue? And we're going to talk about that next time, but I will definitely touch on it a bit today. Thank you. As far as the economy goes, not too bad. It wasn't perfect, and I did say this was tough. But what I did feel pretty firmly about was at the end of last year that we had not had a recession. It seems like most people have got amnesia that in the first 2 quarters of last year, we did have successive negative GDP prints. And so quite a few people were saying, hey, we already had a recession. I don't think so. It didn't, the official stats can be, kind of misleading, and especially at inflection points. And what didn't confirm that, as we talked about last time, was gross domestic income. That indicated we were still in expansion, and it was right. It typically is more accurate than GDP. It's the other way of measuring economic activity. I did note the erosion in the labor market was happening at the end of 22. And, per official reports of this year, you might say, well, no, the jobs market has stayed very, very healthy. Well, yes and no. I mean, it has moved up about 50 basis points, 0.5% from 3.4 to 3.9. Some of that is because of more people coming into the labor force. But what's really been affecting these unemployment numbers in an over-flattering way is the birth-death model. Now, that's a plug factor that the Bureau of Labor Statistics uses to try to assume the rate of new business formations and closures. Normally, it's not a big deal. Normally, it's kind of a steady state type of thing. But when the economy is turning down, then it gives you misleadingly strong readings. And because there have been a surge of business failures, I think that's why we're starting to see these revisions consistently to the downside. And as some on the call, I saw Dean's on here, he's pointed this out before, that full-time jobs have actually been contracting lately, whereas part-time jobs have been increasing. The household survey is also contradicting the farm payroll, NFPs, which is the main one people quote. So I think there's plenty of evidence that the jobs market is eroding. And I think actually it's getting to be kind of alarming in that regard. Okay. So I did say at the beginning of the year, I was worried that the consensus was expecting a recession for this year, because the consensus is often wrong. And I'd like to be a little bit more contrarian, but I should have been concerned because the consensus was wrong. And I was maybe even wronger in a way, because I thought the recession would be in the first half of the year, and that clearly didn't happen. Now, it could be happening now. Recessions are funny that way, because by the time the MBER, which is the entity that is the official recession arbiter, makes their call, it's typically when people felt like we weren't in recession. I mean, for example, in October of 07, nobody thought we were in recession, and that was actually the start of it. And the economy looked pretty good through the first half of 2008 and then off the cliff. And obviously that was triggered by a lot of bank failures. Of course, that can't happen again, right? Well, we had 3 of the biggest bank failures ever back in the spring, as we'll talk about in a moment. But anyway, no recession in the first half, I think it's fair to say. Second half, more debatable. Thank you. And I also hear repeatedly that the U.S. consumer is so resilient. But I think there is growing evidence that that's consumers hitting the wall. This is Google searches of give car back. So a lot of it's like the auto equivalent of the jingle mail that happened back in the Great Recession, when people were sending their home keys back to their lenders. That's happening with cars. And part of the problem isn't just that they can't afford their basic car payments. People were able to, during the COVID period, to buy cars that they really couldn't afford. And part of it was stimulus money, part of it was incentives by the dealers, and very low interest rates, basically no interest rates. But what's also really hurting right now is these car insurance premiums, auto insurance premiums, are skyrocketing. In some cases, people are paying more for their auto insurance than they are for their cars. And that's another kind of nasty outcome because of all that inflation that we had driving up the cost of repairs. Thank you. So what did I miss? I certainly missed the AI euphoria. I didn't see that one coming. Why does that matter for the economy? Because that has driven this very powerful stock market rally in a very limited number of companies, but they're big companies that have a major impact on the market value. And that did help to reverse the negative wealth effect of last year's double bear markets in stocks and bonds, which is very unusual. typically when stocks go down, bonds go up. But that didn't happen last year. And that's one reason why I thought, that kind of lagged effect starts to really hit people, that we would have a tough year economically. But instead, this AI thing that came out of the blue drove up stocks like NVIDIA spectacularly, and Microsoft's been along for the ride. And so it's been a very narrow rally, as I said, and we're going to see some visuals of that. But nonetheless, there's been a lot of wealth created because of AI. And another one, I'd say, we go to the next slide, that the one that's the most been the biggest driver, and kind of another one I didn't see coming, was this doubling of the federal deficit from 1 trillion to 2 trillion. I think there's just not nearly enough focus on how much that's affected the economy. It's really rocket fuel for the economy on a near-term basis. Long-term, it's actually a drag, as I'll talk about in a bit. But the fact that we're running this type of a deficit when we've got sub 4% unemployment is truly outrageous and unprecedented. I mean, we normally only run deficits like this when there's some kind of ultra calamity. So I think it is worthwhile to ask, where will the deficit go during the next recession? And I think it's quite plausible it could be $4 trillion. And that has tremendous implications for, I think, stocks, but clearly for the long-term treasury market, where I just don't think there's anywhere near that kind of demand. And they'll try to sell most of the debt on a short-term basis, but there's got to be long-term buyers too. They can't do all this short-term paper. So it's a major problem that the market is at this point. It was kind of worried about it a couple months ago, but now it's just like, no worries. That's somehow been resolved. Thank you. So this is a really important chart, because this really gets to what I was saying. And I do think fiscal stimulus, to the kind of degree that we're having right now, is like crystal meth. And if you don't know, this interesting factoid or anecdote about World War II is the Nazi stormtroopers, but Nazi troops in general, during the early Blitzkrieg year of like 39, 40 years, they were using crystal meth. That was one reason why they appeared to be superhuman. But eventually that wore off, and then it left the soldiers absolutely exhausted. So yeah, you get this temporary energy burst, but then the payback is wicked. And what this chart shows is I think super critical to look at, where is growth if you adjust for all this money being spent that the government doesn't have, the $2 trillion deficit. And that's it's really negative. I heard a very bright strategist the other day saying that really we're already in a private sector recession. In other words, he was making that adjustment. If you back out all this fiscal stimulus, we're actually negative. And he said it was one of the worst readings since the 1930s. But what we've for sure seen, this is actually a thesis by Dr. Lacey Hunt, who's a brilliant economist and a very successful bond manager, a very rare combination. He says the fiscal multiplier has gone negative. So for every incremental dollar of federal spending, you actually get less growth in the long run. Now, short term, it does create a burst. But I think we've seen the wages of that over the last 20 years with the tremendous increase in government debt, and yet falling growth. So I think that the reality proves his theory. Thank you. Stock market, that was another kind of mixed call on my part. On the one hand, I did feel that an earnings recession was highly probable, felt it was more probable than a recession itself, whereas Wall Street saw higher profits. So I was right about that. Wall Street was wrong. But I did think that it was going to be a more severe earnings recession than it has been so far. And I did think that rallies would be of the bear market variety until the Fed really started cutting rates. And actually, after that, what a lot of people don't realize, you probably hear this, oh, we just can't wait till the Fed cuts rates. Well, the problem is, and just look back at 2000, 2002, or 2007 to 2009, both times when the Fed was cutting interest rates frantically, stocks went down, and they went down a lot. So it's kind of one of those, be careful what you wish for, you might get a good and hard. Now, where that works is if it's a soft landing. If the Fed is cutting and you avoid recession, that is very bullish. And that's why this is such an important aspect of this presentation and really of kind of the investor decision tree that you're faced with right now. Are we going to have a downturn or not? I mean, an actual recession. And, is it going to be mild? Is it going to be soft? Ironically, in 2000, 2002, the recession was very mild, and yet stocks still got crushed. And it's because we had a huge bubble going into that, which frankly, we have had this time too. Thanks. So this is as I would admit, we don't know whether this is a new bull market that started, arguably this October, or a lot of people think in October of 2022, when the market hit bottom at that point, quite a bit below where it was in October of this year. And I will admit, we don't know yet. But when you look at this chart, this is basically the Magnificent Seven versus the S&P 493. So the S&P 500 minus those seven. And there is no rally. This was a couple of weeks ago, so it'd be that line, that lower black line would be up slightly, but very, very slightly. So anyway, it's a very unusual situation, and I do believe that the great market technician Bob Farrell was right that the broader the market, the healthier it is, and the narrower, the less healthy it is. If anything happens to these Magnificent Seven, God forbid, it's going to be a pretty rough time. And I do think that they have more economic sensitivity than most people believe. So anyway, I would say that's my overall stock market call was probably wide of the mark, at least a little bit. Thank you. So as far as international stocks and bonds, I was more optimistic there. I actually put in my partner, Louis Gobb. He liked emerging markets. Coincidentally, he's the subject of a cover story in Barron's this week that kind of tells you that he's a highly regarded guy. And his favorites did really well, Mexico and Brazil. Overall, though, the emerging market index only up about 3%, which is kind of in line with the average U.S. stock, by the way. If you back out those Magnificent Seven, it's a little better than that right now, but not much. No AI effect overseas. They don't have NVIDIA and Microsoft in those indices. So that's probably the main reason why. But if we go to the next slide, what we'll see is that I did, I think a lot of people on this call realize that Japan's been one of my favorites. I've written it up positively numerous times. It's been on my champions list for years. And it's up 15% this year in US dollars. Better in yen. The yen is actually down somewhat this year, and the yen is super cheap and I think extremely undervalued. I think it's a great hedge against a weaker dollar eventually. I did say I preferred emerging market bonds, and that was a good call. They're up about 8% this year, whereas treasuries are still down, not much because of the recent rally in treasuries. But interesting from the low that the emerging market debt ETFs from late October are up 12 to 15%, which is about double what the 10-year treasury has done, and even more than the stock market. And on the right, we just show that there's been outflows out of emerging markets, debt and equity funds, stock and bond funds. Excuse me, and that's really bullish from our contrarian way of looking at it. The average retail investor tends to be a wrong way Corrigan. Thank you. Okay, as far as the Fed and interest rates, this was a pretty good call on my part because I said I thought that the Fed would keep raising and would actually get up to around the 5.5% level. It's currently 5 3/8. That's pretty darn close. And that was above what the consensus thought it would be. And I also thought longer rates would continue to trend higher. As you see on the right, back in October, we actually hit 5% briefly on the 10-year treasury, way above what the consensus thought it would be. My prediction was it would peak in the 4.5% to 5% range. Excuse me. So far that looks pretty good, but there is a big qualifier to that being the peak. I kind of touched on it earlier, but I'll delve into that more coming up. So let's look at the next one. I did think there would be some pretty healthy rallies in longer treasuries on recession fears. And in fairness, sometimes when there's soft landing expectations, that still can bring treasury rates down. That's certainly been at work here for the last month or so. And it did happen in the spring. That's when we had those banking failures. And so that brought rates down temporarily. We got down around 3.3, 3.4, but then a huge move from that level up to 5. And that's one reason why the stock market was struggling there from late July to late October. And as many of you know, I put out a basically take profits, particularly on the Magnificent Seven in late July, and that was a pretty good call for a while. I think it'll be a good call over the next couple of years. My overarching view on treasuries, which I think is very important for everybody to be aware of or maybe disagree with, is that 40-year bond bull market that I rode really from the beginning of my career all the way through 2020, when the 10-year treasury, which had been as high as 14%, actually 15, got down to under 1%, 0.053% at the bottom in August of 2020. It was an unbelievable bond market, bull market, record-breaking in every way, but it's dead and gone in my belief. And so that's why I feel that any of these rallies that come along are to be sold, and especially based upon what I've been calling my 4F scenario, which I'll get into here shortly. Thanks. Credit spreads. Now, I should explain this. These are super important, and I'm going to give you an example why they are so important. It's the difference between what corporations pay on their debt, so it's their cost of capital, versus the treasuries. So this only goes back to, well, 2019, but it shows the COVID absolute explosion in credit spreads. If we went all the way back to 2008, 2009, it would be even more extreme. So this dotted orange line is showing where junk bonds were in March of 2020 during the COVID panic. And they basically got up to, I think that was a peak of about 10 points over treasuries. So it was basically a yield of 13, 14%, something like that. But in 0809, it actually hit over 20% on junk bonds. So, and that was one of the reasons. I mean, it wasn't just junk bonds, it was really everything in the non-government credit market area was absolutely annihilated. That's why virtually every bank in America back in early 2009 was broke. And that's what caused remember the TARP and all those other emergency rescue plans. But the Fed learned its lesson. It realized it can't ever let spreads get out of control again. So what turned everything around in March of 2020, it was March 23rd of 2020, the Fed actually intervened and started buying corporate bonds, which they never had done before. And it was really just the announcement they were going to do it that caused this absolute cliff dive by the yields and the spreads. And that's when the stock market took off. That's when the corporate bond market took off. That's when mortgage rates began to collapse and never looked back. And when you think about it, I mean, the COVID was just getting going. So really all the bad stuff was yet to happen. And yet the market rallied, a few pullbacks, but it rallied ferociously, as did corporate bonds. So it really shows you how important credit spreads are. Now, if we look at last year in mid 2022, spreads went up quite a bit, but nothing like they did during COVID. And that's when things were under a lot of pressure. As those spreads eased back down, even though interest rates were rising, then stocks began to rally and at least stabilize. And corporate bonds have actually done just fine. It's great for us because we own a ton of corporate bonds and we were big buyers last year on weakness. So I can't emphasize enough how important credit spreads are. Most people don't pay attention to them. We pay a lot of attention to them. Okay, let's go to next slide, please. So why have they been well behaved? Obviously, they don't like recessions, and a recession hasn't happened yet. And I think it's also been just a problem deferred, because we're now going to start to see an awful lot of bonds that were refinanced back during COVID when corporations were smart enough to extend their maturities, or another term for that is terming out. Now those are going to start coming up next year, and particularly in 2025 and 26. It's called the maturity wall. And so for companies that have floating rate debt, that it's already hitting hard. So if you look at the average small business, it's paying to borrow money, it's paying 9 to 10% right now. And a lot of those small businesses just simply can't afford that. And that's why small business sentiment is extremely low right now. And since small businesses are about 75% of jobs, that's a big deal. Another reason why I think the jobs market's in the process of weakening. But as I mentioned, very fortuitously, credit spreads did not widen, and that has definitely benefited many of our income securities, especially since late October. Thank you. So this is the biggie, the U.S. government funding crisis. And I was writing about this at the beginning of the year. I said I was astounded at how complacent Wall Street was, that there wasn't this big risk that the markets would not be able to absorb all of the debt that government needs to roll over and newly issue. And there's always the belief that governments can roll over their debt. So if the government's got $9 trillion maturing, which they do over like the next year and a half, it's a massive sum that's coming due, because they have been so heavily reliant on the short end for their financing needs. But what if buyers don't show up and say, well, we really don't want to buy, we don't want the T-bill that just came due to be rolled over. And then they've got this other $2 trillion on top of that. So it's a major problem. And I did worry about it a lot a year ago. I'm more worried about it now, but I had no idea at the time that that deficit of $1 trillion would go to $2 trillion, as we talked about earlier. Okay. So the other thing, which it just doesn't get enough attention, is this quantitative tightening, the opposite of QE, quantitative easing. And it's about $1 trillion a year. Now, the Fed did temporarily reverse it when the bank failures happened. That may be why stocks rebounded, everything kind of stabilized, because they went back to injecting liquidity into the system. But now QT is going in full swing. So they're a buyer. I'm sorry, they're a seller, not a buyer. The big foreign central banks like Japan and China are also sellers. If we go to the next slide, we'll see that it's also happening with banks. And I did an interview. I was actually the host about a year ago with a very bright guy. I won't name his name. At least he's famous as being very bright. But I brought this up and he completely blew it off. And he said, "Oh, don't worry about it. The banks they'll keep buying all the treasuries. They can buy way more treasuries." Well, shortly thereafter is when three banks failed, not because of bad loans, but because of their treasury portfolio, which collapsed in value because of the rise in interest rates. So as a result, banks are actually now sellers of government securities. And I think that's unusual in the fact that I believe they're big buyers of T-bills, but they're selling the long treasuries, which kind of makes sense because that's the part of the yield curve that has bankrupted a lot of them, at least on paper. Now, they haven't failed, but a lot of these banks really, if you mark everything to market, their loans and their security portfolio, they would have negative net worth. So anyway, it's this whole 4F scenario, the federal fiscal funding fiasco, is a train wreck, and I think it's going to get worse. And I do think that there's a distinct likelihood of a $4 trillion deficit in the next recession. And how that's going to get financed, I think, is going to be one of the major issues that the market has to come to terms with over the next year. Okay. So as I said, they're going to rely heavily on the short end. They've been doing that. They probably have to do that even more. That long end of the curve looks really fragile. I think this recent rally by the treasuries, the 10-year and even the 30-year, has got investors thinking that the old playbook of whenever the economy slows down, buy long-term bonds, that it still works. And it does to an extent, and it does short-term, but I do think that the reality of this just overwhelming amount of supply is going to create a different outcome. And this is, for 40 years, every time, at least up until 2020, so pretty much 40 years, whenever bonds would get hit late in an expansion, inflation would heat up a bit, I was a buyer. This is the only time I've really felt like long treasuries are not the play. Now, there are ways to play it, particularly with the aforementioned emerging market debt. And the nice thing is you're getting better yields, and in those countries, the policies tend to be actually more healthier, more responsible than what we're seeing in much of the West, if not all of the West. So anyway, I think that just kind of the old thing of buy long-term treasuries in a downturn, economic downturn, is going to be discredited. Okay. So the dollar, I've said repeatedly and written repeatedly, it was the worst call the last 2 years. I really thought it was going to be hit hard because of these massive deficits that have been even more massive than I thought, and the money printing to fund those. But there was obviously a shift in Fed policy. And Jay Powell has made a transition from what I would call the, Inspector Clouseau, like Peter Sellers and the Pink Panther, kind of a bumbler, into, Macho Dirty Harry of central bankers. He's been very, very aggressive in raising rates. To his credit, he's kind of alienated the rest of the Fed because he thinks they're wimps. And I don't know if you heard his off the mic. He thought it was a dead mic. It was a hot mic, and he used the F word and kind of aimed at some of his subordinates. But lots of rumors that he's really disgusted with the Fed economists who kept telling him that inflation was transitory back in 2021 and 22. Anyway, that gave the dollar a huge boost, but since really the end of 22, it's been kind of largely range bound. In fact, lately it's weakened because of this decline in interest rates. So whenever interest rates come down, the dollar goes down as well. That's why you've seen gold breaking out, which is pretty remarkable considering the Fed hasn't actually started cutting yet. And the gold miners have really perked up lately, which, as some of you know, I wrote those up favorably here a couple of weeks ago. Thank you. But I do think the market's getting ahead of itself on rate cuts. There's an assumption that rates are going to get cut as soon as March. It could happen, but I think if it's going to happen, it's going to be because the economy falls off a cliff. So once again, I think it's be careful what you wish for. But the Fed actually is continuing to hike each month because they're doing QT. So they have not, even if they stop raising interest rates, they are still tightening. And you need to be aware of that. So I think it is a big mistake to think that quantitative easing or tightening is a non-event, because if nothing else, it aggravates that 4F scenario, that fiscal funding fiasco, because it just creates more selling at a time when so many other what used to be big buyers are now big sellers. Okay. Global housing market, I probably should have said that I was expecting the bursting of a global real estate bubble rather than just talking about housing, particularly U.S. housing. Certainly, it's true that housing markets in countries like in China and some of the Scandinavian countries are really struggling. I just saw French home builders or home building activity is crashing as it is in Germany, but Sweden's really been bad in that regard. But even in the U.S., where existing home prices have supposedly kept going up. I'd say in many markets, good luck selling. You might think your house is worth $2 million, but the market may have a very different idea of that. The home builders, though, because they have to keep the inventory moving, they are cutting prices. Housing prices for new homes are now down 18% year over year. That's a volatile number. I wouldn't be surprised if it bounces up, but I think that's the trend, is to lower prices. And I think we've got, let's go one more here. I think we have affordability. Yeah, so if you look at this chart on the right, affordability is terrible. I mean, it's like worse than it was leading up to the global financial crisis. But their home prices are, existing home, quite sticky, because who wants to give up a low rate mortgage? Do you want to go from a 2.5% mortgage to 7.5%? No. So it's very understandable that sellers are reluctant to move. And I did feel affordability would continue to worsen, which it has. And what's really hitting hard is, ironically, not housing, but in the office market, which was having its own problems with work from home, et cetera. But it's just brutal with some of these office buildings. Fit down 50% or more in price. And we were offered, we were encouraged to make a bid on an office building in Seattle that originally transacted before COVID at $15 million, has $12 million of debt, and supposedly we could buy it at $3 million. But it's not just Seattle. I mean, this is happening in many cities, even cities in Texas, where you don't have some of the the exodus away from the big blue cities like you do in the north and on the left coast. We're being told by real estate experts that on the east side, apartments are down 20 to 30% in price from their peak. That seems high to me, but they're adamant that that's the case. So there's lots of evidence that the latest real estate bubble has popped, even though existing home prices are hanging in there. Thank you. So energy, it's been kind of my favorite area off and on, but mostly on since really the summer of 2020. And it's been phenomenal. Not this year for the big oil and gas producers like Exxon and Chevron. They're having kind of rough years, but they were phenomenal in 2021 and 22. So they were due to take a break. But what's been continued to be fantastic, and we've owned a lot of these, are the pipelines, midstream energy infrastructure. We used to call them MLPs, which are up, the index is up about 25% this year. And we've got a little bit more diverse mix. So we're having a great year, but not 25%. Sorry about that. Okay, that's a couple of my fans, Roscoe and Nova in the background. So anyway, Monster Oil had a monster rally off the June lows when I did my big table pounder on energy. It went from like 67 to 95, and then it's been hammered lately. And there's disappointment about OPEC and a lot of confusion, but I think it continues to be an extremely tight market, healthy demand and deficient supply. Thank you. So I didn't quite get the $100 number, but 95 was pretty close. But I then also said I thought 150 was not unreasonable. That was really assuming that the Ukraine situation would devolve into more of an energy cutoff than it has so far. It still could happen, but I got to say that it's been surprising that oil has been as plentiful. And when I say plentiful, not as much of a shortage as I thought. There is definitely a deficit. OPEC is saying I think the deficit is 3 million barrels a day in the fourth quarter, which is huge. I don't think it's that much, but I think it's at least 1 million barrels a day shortfall. And when it was $1 million barrels a day surplus, that was enough to just crush oil prices back in like 2015, 2016. So much higher oil prices was the reason I thought a recession would be aggravated, and another kind of contributing factor. But so far, these higher oil prices have been fleeting and certainly haven't really hurt the economy at this point. Thanks. So for sure, a better year than I thought. There was definitely turbulence in the spring and fall. The spring, of course, the banking crisis. The fall, kind of that spike in interest rates from 3.4 to 5% on the 10-year Treasury. And this is despite the fact that a couple of my biggest risks have actually been at least partially realized in the case of real estate and fully realized in the case of the federal fiscal funding fiasco. So bull markets are known for climbing balls of worry. So maybe this one really is a bull. I don't think so. I think it's still a bear market rally, but I don't mind positive returns, even if I think they're questionable. So again, I think the main reason for why we didn't have a recession was this inexplicable and indefensible increase in the deficit. It's just really hard to, I guess you can just say, returns are returns. It's been great, but there's going to be a payback from that. We all know that. It's just common sense. So I'd say fasten your seatbelts. I think we're ready for questions. Oh, there's just a couple of images on this, but this is from my friend Danielle DiMartino Booth, and she's making a very valid point that even with all these trillions of fiscal stim, where is the benefit for real after-tax incomes, which are actually below where they were prior to COVID, real personal consumption kind of on the trend line, but no big surge there. So I think it just gets to this point that this government spending to try to create economic growth doesn't work and actually has a counterproductive impact. Okay, we have one more. This is just pointing out that if you look at how people, the typical fund manager, according to the latest B of A survey, 75% believe that there is going to be a soft landing. And that's the big risk. When everybody's expecting bad news and bad news happens, the market reaction can be muted. It can even go up. But when there's an expectation that things are going to turn out very well, that's when you can get the super aggressive and unpleasant reaction. So again, let's hope I'm wrong. I like to be right when I'm predicting good things to happen, like coming out of COVID when I was early, when people say, you're crazy, why are you bullish now? I mean, don't you realize how bad things are getting? And so I don't like to be in this position, but I've got to be realistic, and protecting client capital is my number one responsibility. So now we're ready for questions.
And it looks like we got our friend Rourke O'Brien raising his hand, so we'll start with him.
Yeah, am I muted?
No, you're.
So Dave, would you comment on this ESG thing? You know, the ESG thing showed up out of nowhere, and now it seems to be going in reverse every bit as fast as it showed up. Could you comment on that a little bit?
Yeah, I mean, I'm probably going to run this chart in the next webinar that shows the performance of the renewable energy stocks versus traditional fossil fuels. And for a couple of years, the renewables were absolutely crushing, the Exxons and Chevrons of the world, and now it's reversed. I mean, there's been an absolute bloodbath in this. This would certainly be a counter argument to we're in a new bull market theme, because that was considered to be one of the best plays. But yeah, I think people are waking up to the ESG. There's so many flaws with it. Number one, I mean, I think Tesla's kicked out of the ESGs, and Occidental Petroleum is in. Oxy's trying to do the carbon capture thing, which is going to be really tricky and expensive. But it's a weird way of categorizing companies, and I think there's a growing awareness around the world that abandoning fossil fuels prematurely is not wise, and it's creating a tremendous voter retaliation. Even in Europe. And people, they look around and they see that there's over 1,000 new coal plants under construction or in design right now, a lot of those in China and India. And it's like, okay, so they're going to build all these coal plants, and we're really going to help by driving EVs. Or in China, where the biggest EV market by far is China, and yet most of those EVs are charged off their coal plants, which emit way more pollutants than if they were using natural gas to create electricity. There's just a lot of contradictions in the whole, what I call the great green energy transition. And I think people are waking up to those and saying, we're not going to pay outrageous I mean, for example, California has got more renewables than any other state, and yet it's also got the highest electricity rates. So I think people are getting fed up, but we'll see. You can see my bull in the background there, right? So people think it should be a bear. I really am inherently bullish. I always try to find something to be bullish on. Anybody else?
I'll ask another question, Dave, since somebody else seems to be interested. So the government borrowing is bad enough, but the consumer debt is like, is there no end to this? I mean, they just keep on going up and up and up. Is the government's reckless borrowing incenting them, or what do you make of that?
Yeah, it's a great question. I think it's the tale of two, like the old Dickens Tale of Two Cities. You've got consumers. I mean, I think it's roughly 50%, and this is from the Fed, roughly 50% of all consumers cannot afford an extraordinary expense of just $1,000. And we talked about the explosion of the buy now, pay later, and how much credit card debt's out there and so forth. And so there's a big segment of the US population that I think is really hurting right now. And the pain's going to get worse as these higher interest rates increasingly kick in. There's a lag effect. But then you've got a lot of consumers, fewer in numbers, but still substantial, and they control the biggest pool of assets who actually like the higher interest rates. A lot of the people on this call, I mean, instead of sitting there getting nothing on your cash and being forced to buy things you really don't want to buy because Tina, there is no alternative. Now there is an alternative. The latest, instead of Tina, it's T-bill and chill. just buy a T-bill and just to chill out and collect your 5% and you're good. And, that's true that tends to happen every time we've had an inverted yield curve. But the problem with that is that you're not locking it in for a very long time. That's why it is important to be looking around at places where you can capture high yields for many years to come. I just question if treasuries are the best way to do it. So, yeah, I think it's true that there are consumers in trouble. If you look at consumer balance sheets overall and you look at debt service as a percentage of net worth, it's actually quite low. There's supposedly been $46 trillion of household net worth increase since COVID. I really doubt that number. It just seems way, way too high, especially with real estate cracking and all the money that's been lost on crypto and NFTs and SPACs and memes. And I mean, there's been a lot of money destroyed. And then think about the bond market, how much money's been lost. At one point here recently, Deutsche Bank Jim Reed estimated that there was 75 trillion in losses from global bonds. So not just in the US, but around the world. Now that's gotten better with the rally here, but it's still a huge number. So yeah, good point. And I think we're not through the worst of some of these negative ramifications.
You got Robert raising his hand. Go ahead, Robert.
Hey, David, Robert Mullen here. Appreciate
Hi,
your
Robert.
time. Appreciate your time today. I wanted to maybe get a little bit more of your thoughts on precious metals and gold in particular. We're about to clock the first monthly closing of gold above 2000 in history. It seems like central banks had kind of figured this out, a year and a half ago, and have been really aggressively accumulating gold. The reason gold hasn't gone up that much is because the Western retail investors were selling similarly as fast. Seems like that is slowing down and maybe pivoting here with the idea of the Fed possibly, the next thing being a cut at some point. So, what's your feeling about sort of the gold action here, particularly in the last couple of weeks, and how would you think about expressing that portfolio-wise?
Yeah, thanks, Robert. That's great stuff to bring up. And yes, I think gold's price action recently is very encouraging. I think it's encouraging what's happening with the miners. The miners, as you're well aware, have tremendously lagged gold. I mean, gold is making a new all-time high, as you just said, and yet the miners are a fraction of where they were when gold was, 1,800 or so at the peak of the miners back in 2011, 2012. And they've just been in a relentless bear market other than 2020, where they went nuts. And we made more money for clients in gold's mining stocks in those just few months than I think we've ever made in such a short time with any other sector. And it was because the Fed, of course, was in a full easing mode. It was a very inflationary response to COVID. And that's why I think a very inflationary response to the next recession will be rocket fuel for the miners. And, people just hate that group. And kind of to your point that when you see something where there's persistent outflows, that's kind of what I was saying about emerging markets earlier. To us, that's a very bullish sign. Most U.S. retail investors are, they zig when they should zag. And so we find that encouraging that, and I think, your other point was, look who's buying. The big central banks are buying gold in huge quantities, really record-breaking quantities. And I think the reason they're doing that is that they're not comfortable holding treasuries because they don't trust the dollar, they don't trust the Fed, they don't trust the Treasury. So what used to be the ultimate go-to reserve asset, which was U.S. Treasuries, is now, I think, gold. And I think you're seeing some of these countries positioned to be on kind of a stealth gold standard, such as China. And I think there'll be more and more of those. Supposedly some of these European central banks are preparing for a return to the gold standard at a much higher gold price because the gold is too small a percentage of their economy or their liabilities. So they to really have good gold coverage of, let's say, for the U.S. government, all the debt that's out there, the 33 trillion, you'd have to have gold marked up, by 5 or 10 times. You probably have a better estimate of what that number should be than I do, but I've seen 10,000, 20,000 gold. And so the gold bugs have always believed there's going to be this massive move at some point, and it keeps getting, there's been some fleeting ones, but it keeps falling back because and this time around, as I said earlier, the Fed has had a surprisingly muscular response to higher inflation. And right now it looks like they're winning, but I really do think that if you want to bet on who's going to benefit the most from the Fed reversing course, the gold miners are likely to be right at the top of the list. I have a feeling you probably agree with that.
So Godot may finally have arrived. So we'll cross our fingers.
Right. Godot and gold. Goldo.
Great. Thanks, David.
Thanks, Robert.
Mark
Picking up
Furman,
on
go
that,
ahead.
Thanks. I have two questions, but first, just to pick up on the miners discussion. I mean, do you think chances are more likely than not that despite sort of, miners starting to show some life, um, as you said a couple minutes ago, until the next easing cycle, it's unlikely to sort of see, them really rip into a new, powerful bull market?
Yes, I think you're right about that. And then what I do worry is that, as I said, the market's gotten very euphoric about the Fed cutting and cutting soon. And I wouldn't be surprised if senior Fed officials start to talk that, walk that back and start saying things like, well, don't get ahead of the game. We don't like how much the rates have come down. Because really what that's doing is kind of working against them. If they're still trying to get inflation lower and you've got the bond market easing for them pretty dramatically, I don't think they want that to happen yet. So I think you could see another rally in the dollar and a sell-off in the miners. So I'd be careful chasing them. They've had a decent pop here lately. So I don't think, to your point, I don't think this is the liftoff moment. I just think we're getting closer to it.
Understood. So, you've referenced in some of your writing some of the research, I think, from Goring and Rosenzweig, if I'm pronouncing that right. Curious whether you have done any work and have thoughts on sort of their resource fund. I don't think they have an ETF, but they have a mutual fund.
I don't. I mean, I think they're really good at what they do. So I suspect that they've done quite well in rising commodity price environments, but I also suspect they've had a pretty rough year, but I haven't actually looked at it. But I'm a big fan of their work. And I think one thing they really are on top of is what's happening to the Permian Basin, which, I just listen to so many people talk about oil like they know what they're, like they're experts. And oftentimes they don't get into anywhere near the kind of detail that Gary Rosenzweig does, where they look at, production trends and productivity, which is pretty poor, even in the Permian. So if you don't know, the Permian Basin has been the biggest driver of U.S. oil production growth over the last 15 years. And the U.S. has been like 90% of global oil production growth. And all the other basins, so, it's not just the Permian. Permian is the star. They call it the layer cake because it's so deep. It's got multiple pay zone layers. But the other basins are already declining. And shale has a very high decline rate, especially with oil. It's about 40% a year. So you have to keep drilling like crazy. And we're not. The drilling rig count keeps falling. So there's fewer and fewer rigs drilling, way down from where it was 10 years ago. And what they've all been able to do to maintain output, because you hear this on TV all the time, record-breaking U.S. production. True, to a degree, it's slightly above where it was in 2013. And in my view, and I think these guys agree, there's a couple of reasons why they've been able to do it. And I think these guys, I'm talking about GNR, Gary and Rosenzweig, is because they've been high grading. So they've been drilling out their best sites, their best rock, but they can only do that for so long. And then they run out of those, and there's evidence that's happening. And then also they've drawn down the drilled but uncompleted wells. So when COVID hit, there are all these wells that were, think about like houses where you had all these houses that were under construction. COVID hits, they stop building, they get this big inventory of partially built homes. So the first thing they do is complete those. That's what they've been doing. But now those things have plunged way, way down. Can go a little further, but at some point we have to start drilling again. I think you're going to have some scary production numbers and when you start to actually see the Permian falling in output, I think that's when people are going to have a real aha moment and realize how cheap oil is. Hope that helps. Got a few more minutes if anybody else has got questions.
David Les Cronk here. A question on interest rates. That's been a lot of focus on the rates going up and I guess looking forward and some consideration of the Fed dropping rates in the future. And I've seen a lot of focus on how high the rates are, and reality is historically, what's normal? Aren't we closer to a normal range, and we were kind of spoiled with super low rates for a while, and what should we expect long term?
Yeah, absolutely. I mean, 5% that used to be a low rate. And, I remember the early 80s, and it was, well, the prime rate went to 20%. I remember buying CDs for clients in the early 80s that were over 20%. And so, yeah, these are not historically high rates. They're actually very average, right? That was an extreme period, of course, in the late 80s. But 5% something. But the difference is that, of course, that's the treasury rate. So when you start looking at other markets like the private credit market, or supposedly private credit loans now are in the teens, because they're floating rate, and there's, you know, those are professional people that are on the other side that are, you know, demanding a high rate. And I think that's partially because they're expecting rising defaults. But and when you look at 5% short-term treasury, or, you know, right now the 10-year is 4.3. I'd say that's not high, and especially given this inflation shock that we've had, which we went, you know, basically 20 years, if not more, with subdued inflation, very few flare-ups. But this time, this was a heck of a flare-up, and we basically had double-digit inflation for a while. And I think as a result, the bond market, at least any rational player in the bond markets, go, well, wait a second. Do I really want to accept a 4.3% yield for 10 years when inflation could flare up again? And especially if they do the math and they look at these deficits that are so huge, and we are going to get a recession at some point. And I think it's very reasonable to expect that 4 trillion. Some people think it's to be more than 4 trillion. I mean, credible people. And I just think that is going to make these rallies that we get, which means up in price, down in yield, fleeting. So yes, I would agree. And as I said earlier, I think this expectation that the Fed is going to start cutting right away is probably mistaken. But I also concede that there's so much debt in the system right now that higher interest rates bite, especially once time goes by. Like I said earlier, you've got so many people termed out their debt. They extended their maturities, like homeowners that refinanced, and they've locked in 2.5% to 3%. So they're pretty well insulated, but a lot of these corporations, they only turned out for 4 or 5 years because that's kind of about as far out as they could go, particularly with less than investment grade. So those are going to be coming back up here pretty soon at much, much higher yields. And that's where I think you see a lot of bankruptcies. Companies that really couldn't afford to be paying 4 or 5%, definitely can't afford to pay 9 or 10%. And you're already seeing them. You're seeing a real surge in business closures. And I think that's going to accelerate as we get into 2024. So that will tend to keep a bit of a lid on interest rates, less as you start to see a lot of pain and suffering from these higher rates. Anybody else? Okay, well, I appreciate the questions. They're always great. If anybody thinks of something that they didn't ask during this, don't hesitate to send us an email and I'll get back to you on that. Thank you very much for your time. Happy holidays to everybody. We'll be talking to you after the first of the year.